First of all, 9% is a short-term rate. So let's say that the long-term, 10-year Treasury note, let's say, is 12%. All right? That's 3 percentage points premium. So if you have a corporate bond, you won't even be satisfied with 12%, right? You would want, what's that compensation for? It's called credit risk, right? Credit risk. So if you want to try and project the value of a bond, what you have to do is a couple of things. The real rate is going to remain constant. You have to predict where you think inflation is going to be. 6%, 7%, okay? And then you have to get an idea where you think the credit premium is going to be. Let's say right now it's 3%. Typically, when does the credit premium go up? And when does it go down?
We want more returns, credit premium rate increases.
When the risk of default of any corporate bond is...
Right, yeah, so when the risk of default goes up, right? When does the risk of default typically go up? When the economy does well or when it does bad? Right? So what you have to ask yourself is, do you think the economy is going to do well or not? If you think it's going to do poorly, and the credit premium right now is 3%, you would say, well, maybe you can make an argument for the credit premium being 4%, 4.5. Then you add up those numbers, and then you just do a straight bond calculation. Follow me?
But it's still uncertain.
Oh, it's still because you're using estimates. But that's so it's actually a little bit easier within the case of a bond, but it's still an estimate because you have to project inflation, you have to project the credit premium, all right, and then run the numbers. But that's actually an interesting question.
And what does the Nifty or the other stock exchange, what are the standard models that they follow in order to predict stock values?
They do not predict, right? So that's left for the analysts. So the NSE does not predict stock prices.
For example, in the short run, if the if the interest rates are going up, then
right.
Is that a good time to buy so-called AAA bonds? Good time to buy.
Well, if you expect interest rates to go up, there's a couple of things.
So if the interest rates have already gone up,
if they've already gone up,
then
this is any bond, right? Because when interest rates go up, bond prices fall.
correct.
So if you think they're not going to go any higher, that's a good time to pick it up. Absolutely.
Then when the interest rates go down, the yield, because that's the time when the yield is unseen. When the interest rates are higher.
Well, there's two different things, right? Interest rates either go up or down. When interest rates go down, the yields go down as well.
Yields go down as well, yes.
All right?
Correct.
But the prices go up. So if you're a bond investor, what you would want is you want rates to go up and then level off, and then you buy bonds.
Then you buy bonds.
Because at that point it'll be cheap. So that's how that goes. Any other questions? All right, so I have a question for you. All right? How many of your professors get angry at you? Huh? Same way? Or do they just, they don't mind your talking like that? They don't mind, really? They do mind? Good, so. All right, so I hope that you got some use out of this session. I think Dr. Mishra mentioned this before, but he's been very kind. He's asked me if I would come back, spend a bit more time, more so in a classroom environment where you can actually sit and work through stuff. And I think that would be kind of interesting. So even though I did get a little angry at you, I'm more than happy to come back another time and try it again. All right, so again, I thank you for your attention.
Thank you.